everyone. So we get to continue our conversation somewhat away from monetary policy and into the conversation on the policy environment. We'll also cover how the economics interact with that. So first up, we will have some comments by Arnaud there, the chief European economist at Citigroup.
Thank you very much. Just after me, you will have the exciting speaker, Michael Drury. So I'm just here to warm up with the room. And so we're going to talk about the new question environment. I think the topic I want to focus attention in is the slightly odd situation we're going to have in the next few years or so, the remaining of the cycle. In that we're going to operate into what I think will be a context of limited policy space. I think that this has pretty significant implications. The past few months we have relatively soft data, in particular in Europe. This is not, from my point of view, certainly pointing to the end of expansion, but I think it's been a reminder for many people that expansions don't go on forever. At some point we will face a proper downturn, and then the question is how do we deal with it? And I think that question will probably intensify over time. And then when we look at this, we have to recognize that we are not, and I think we've not been for a long time in a normal situation. We always like to talk about normalization of policy, and I think things are going to be abnormal for a long time, and probably for the remainder of this cycle. Abnormal in particular, in that I think we have a very, very significant asymmetry between the ability we have to respond to upward demand shock or downward demand shock. If we've got an upward shock, we're all okay, because if we need to regain control of events, we can deploy monetary policy, fiscal policy, macroprudential policy, even if we want to tighten micro-supervisory policy, we can. It's a wealth of tools that we can use in combination to regain control of it. But if we have a shock to the downside, and we have to effectively find a way again to boost, to support aggregate demand. What do we have? And then to forget macroprudential policy or micro-supervisory policy, they're not conceived for that purpose, and they're certainly not staffed for that purpose. So we go back to, I think, monetary fiscal policy. Then on the monetary side, I think objectively, the ability of monetary policy alone to support demand will be limited. So sure, the unconventional policies that have been used over the past years have worked, and I've got a bit of sort of personal political capital involved in that, so I'm not going to say anything different. But still, and I don't like, by the way, the word unconventional. I don't think they were unconventional at all. I think they were unusual, but I don't think they were fundamentally, conceptually, intellectually unconventional. But I think that objectively, the ability of monetary policy alone to provide, again, significant boost to demand is going to be limited. And I think it's going to be limited because fundamentally the way these policies have worked, or asset purchasers in particular have worked, aiming at delivering financing conditions that were stimulative for growth and for consumption and investment, it's been essentially to try to, having reached the effective lower bound for interest rates at the short end of the curve, to after that squeeze as much as possible all the premium across the whole constellation of rates, so term premium, equity risk premium, credit risk premium, everywhere. And I suspect that we have already extracted so much in terms of premia across the constellation of prices that there's not necessarily that much more that can be done. So of course it is always possible for central banks to do more. If central banks want to deliver yield curve control, you can do it. You don't have to buy assets. You can actually enter simple interest rate swaps. There's no limit to the amount you can do, and it can deliver any form of yield control that you want to achieve. So there's always tools that you can deploy. My question is whether realistically that will have that much more of an effect on demand. And so if that is true, and if we are really going to operate over the remainder of this cycle or over a number of years in a context where anyway we will be living with low nominal rates, and because of a lower level of the equilibrium rate or because of very well behaved, to put nicely, inflation expectations, then we're going to effectively operate much closer to the lower bound anyway, and therefore the fact that yes, there may be limit to how much monetary policy can support demand, I think that applies. So if that is true, the implication is next time we have a shock to the downside and we need to deploy policy to support demand, then the emphasis has to be on fiscal policy. It has to be fiscal stabilization. If you want, last time around, I think most of the burden was carried by monetary policy, certainly in Europe, and the next time around, the main role will have to be done by fiscal policy. And that raises questions generally. It raises questions in particular for Europe. So I'll leave a little bit the global question for my conclusion. But I think it raises a very worrisome question for Europe, because in Europe, fiscal space is actually very limited. I don't think it is limited because of high debt levels. Debt levels are not particularly high in Europe compared to other large advanced economies. Certainly not if you look at the debt metrics that matter. I never particularly like debt to GDP. I think it makes no sense whatsoever as a way to look at debt. You've got there's plenty of other metrics you can look at, including looking at debt relative to government revenues or these sort of things. And then on the whole, Europe doesn't look that bad. So this is not really the issue. The issue for me in Europe is what we did 8 years ago at the start of what became really the Euro sovereign crisis, where we decided to transition government debt from a riskless instrument to a risky instrument. So if you want the points, symbolized by the famous Deauville agreement between Angela Merkel and Nicolas Sarkozy at the time, where they agree that government debt should be defaultable. And that seems to make a great deal of sense in a monetary union. If you don't want to have automatic bailout and therefore fiscal transfers between countries, it makes sense that the debt of every government can fail. The problem is that this has very far-reaching impact on fiscal policy. Because the moment government debt is no longer a safe haven, I think you seriously endanger the ability of fiscal policy to stabilize the economy in a downturn, even merely by allowing the use of automatic stabilizers. If government debt is the safe haven, what happens when you hit a downturn is that your cost of funding falls. Because your cost of funding falls, at the time the government can deploy its balance sheet, let effectively the deficit increase, to supplement the lack of investment or consumption in the private sector through the budget. So this is the automatic stabilizers. But if the government is not the safe haven, if the government is private credit, what happens? It behaves like private credit. So when you hit a downturn, when things become tougher, the cost of funding of the government rises instead of falling. And if at that time you effectively expand the deficit, what happens is that because you're borrowing when it's expensive to do so, your debt dynamics start to become adverse very quickly. And then you can enter into divergent dynamics of your debt, and then very quickly, either you stop on your own, or the market stops you. And that implies that at that point, fiscal policy is no longer counter-cyclical, it is neutral if you are lucky, or it becomes pro-cyclical. And what I'm saying is not a figment of my imagination. It is exactly what we experienced in Europe in 2011, 12, 13, and so on. To the point that, some of you might remember, in a speech in Jackson Hole in 2014, where there were lots of things, Mario Draghi gave a message to government, which was, hey, if you're not going to work with us, at least stop working against us. If you want to let monetary policy carry all the stabilization burden, at least don't make the central bank's task more difficult by contracting fiscal policy. But I think that the pro-cyclical nature of fiscal policy at the time was not just a matter of choice. It was partly the consequence of the fact that we had transitioned public credits to private credit. And that remains the same. That remains the situation today. And therefore, so now it doesn't show all that much because we're in the expansion phase of the cycle. But my concern is that the next time we have a downturn, we will go back to what we have known, and a number of countries in the euro area will not be able to deploy fiscal policy to stabilize the economy at a time when monetary policy is unlikely to be truly available. And by the way, what I say is not just true or relevant if we have a global downturn. It's true even if you have an idiosyncratic shock that affects asymmetrically one country, because within a monetary union, given that monetary policy has to be calibrated for the whole and not for any individual country, any country has to be able to deliver stabilization, if you want, on its own, and therefore for the asymmetric shocks. And even though all the projects that Europe has in the area of what we call capital market union and banking union, which are intended, and François Villeroy has been extremely involved in this agenda, all this aims at improving risk sharing, the diffusion of shocks, asymmetric shocks across the economy, and therefore increase the resiliency of individual economies. Still at the margin, I think that fiscal stabilization is absolutely crucial to allow us to have to really have stabilization when the next shock hits. So what I'm saying here, I don't want to sound overly negative or depressing, but it's that at the moment we are operating in an environment where objectively our confidence that we can deal with the next significant downward shock has to be relatively low. And the first part of what I said, which is that monetary space is reduced, I think applies globally. The second part of what I said, which is that fiscal policy also has limited space, I think applies specifically to Europe. The first part of what I said, so limited monetary space everywhere, implies that the likelihood that we need to have monetary policy operating in support of fiscal policy becomes stronger. And that leads to, I'm going to have two directions in which I think this is in terms of reflection, but the first conclusion of everything I have said so far is I think that we've got to think whether the model of pure independence of monetary and fiscal policy is actually the optimal model for the future. If going forward, fiscal policy has to play much more of a role, and if fiscal policy is actually available when debt is seen as safe, and debt at the end of the day is seen as safe because there's a perception that it can be backstopped by the central bank, that implies that some form of coordination or at least consistency between monetary and fiscal policy has to go up the agenda. At times I have described the independence of central banks to use, I'm going to borrow a term from Charles de Gaulle, given that we're in Paris, as independence in interdependence. He was not talking at all about central banks. Of course, he probably had no interest whatsoever in the issue. But I think the term of independence in interdependence is actually quite appropriate. We can have and we should have independent central banks, but we've got to recognize that now the interaction between monetary and fiscal policy is going to be more relevant. That, by the way, leads me to a question for Europe, which is whether we're well organized institutionally to deliver that. The way personally I have always interpreted monetary dominance is the notion that the central bank can do whatever it wants, and including financing the government if that's the way to deliver its objective. But the way we have tended historically to think about it was asymmetric. It was the central bank should not, or the government should not force the central bank to finance it. So hence the notion of no monetary financing, which we have embedded in the treaties, on the prohibition for governments to fund governments. I don't think we thought enough about the reverse, which is what happens in a situation where the risk of deflation is significant, where the good way for the central bank to deliver its objective is actually to fund government spending, and then should it not be allowed to do so? I make a discretion. A few years ago, many people were talking about helicopter money as a possible tool in the next downward shock. The helicopter money, from my point of view, is actually not really monetary policy. It's actually fiscal policy financed by the central bank. So I call it, which is much less sexy, monetary finance, fiscal reflation. But I think it's much more accurate. Let me just explain that in a second. The notion of helicopter money, as many people think about it, is the central bank giving each of us $1 million or €1 million, so creating our account for us to go and spend the money. But if you think about it, so imagine that the central bank does this, that the central bank is creating a liability by creating our account with money. And this has to be matched either by the creation of an asset or the destruction of another liability. My balance sheet needs to be balanced. If the central bank is just crediting people's accounts, there's no creation of assets to match this. Therefore, it has to be matched by the destruction of another liability. What is this liability? Equity, which is essentially the stake that the government has in the central bank. That means it's fiscal money. Essentially, it is the central bank distributing a fiscal asset. And therefore, you've got to question as to whether the better way to do it is not simply for the government to credit the account of the government, on the government to spend money. Governments are pretty good at spending money. And I would expect that a good government knows rather better than the central bank how to put the money in the system to maximize the effect it has. So I've probably gone in way too many directions. But I think one first area that we should explore from a policy point of view is the interdependence or the consistency, I could go as far as saying coordination, between monetary and fiscal policy, and I think that will be unavoidable. Certainly I think it will be unavoidable in Europe, and that raises many institutional questions. The second conclusion that I wanted to have specifically about Europe is that really our confidence in our ability to weather the next shock has to be related to progress on an institutional reform of the euro area, and specifically on the fiscal front. If I am right in everything I said, and I'm probably wrong in much of what I've said, but if I am right in any of what I've said, it is okay to work on a banking union, on a capital market union. Is very important. It improves, as I said, risk sharing, risk diffusion across the economy. It makes individual economies more resilient. But we will not restore proper stabilization capacity unless we give again to governments access to a safe debt that they can issue in a downturn. We need to be able to recreate effectively what I said was destroyed 8 years ago, which is on which in my view is absolutely the key to credible fiscal stabilization, a safe haven nature for government debt. And this can be done in different ways. It can be done by essentially transferring to a federal instrument, a federal budget, the role of fiscal stabilization, which is pretty much what you have in most countries or union, including the US, for instance. Or you can find ways to restore access to individual governments in their national budget to a safe debt. And that takes us another route, of which I think by far the most promising is to split government debt between senior debt issued in amounts that are consistent with the stabilization requirements and subordinated debt, which is what they want to issue for whatever else they might want to do. But I think without a progress on the on this fiscal framework, or on the institutional framework of the euro area, we should not be overly confident that we can realistically stabilize the economy in the next downturn. And this, of course, has totally dramatic implication. So I don't know how long I have spoken, because I always speak too long, and I was trying not to, and probably compensating for this by speaking too fast. But I guess for me the main conclusion of I think this short assessment is that we are not anywhere close to truly normalization, that we are still engaged in a sort of race between on the one hand the economic cycle, and on the other institutional reform, in particular in Europe. Now that should create actually incentive for policy to remain on the accommodative side, because in a way it makes it less dangerous to overshoot the objective than to undershoot it in the current circumstances. But the key point is that we need to follow very closely what is happening, and I'm afraid in the near term nothing is happening, to reform the euro area in a way that delivers, again, stabilization tools. This is even more important, as I think that there is some interaction between that progress or not on institutional debate, on the institutional reform, and the cycle. I think it is reasonable to expect that if you make institutional progress, what happens is that creates enough confidence in stability going forward, so therefore enough clarity about the operating environment of European firms or global firms going forward, that then it does encourage them to invest. On that alone expands the cycle and increases also the level of potential output, and so not only extend the cycle in duration, but also raise generally the path of growth. On the other hand, if you maintain a too much opacity as to what the ability of policy to respond to shock is going forward, then that alone, I think, can generate enough uncertainty, not to say anxiety, that it causes investment and possibly at some point consumption to be held back, and therefore that actually brings forward the point at which the cycle may turn around. So not only do you have a race between the two, but I think you've got some form of positive interaction between the two. And to support this last observation, I think we've got evidence, because we have seen in the euro area evidence for several years that when we had a plausible concern about a breakup of the euro, followed by a plausible concern about the risk of a deflation regime, both thankfully put to rest by the wonderful policy of the ECB. But during that time, we saw that essentially investment was being held back. And once these fears have been, again, I think I would credit mostly the ECB for that. Once these fears have been put to rest, at least temporarily, then we've seen investment demand being unleashed. In the UK today, we see exactly the same sort of pattern. The sort of total uncertainty created by the Brexit process, where 2 years after the referendum, we have made exactly zero progress on defining what is the model that the UK will follow in coming years. That uncertainty, I think, can really be expected and be seen today to have a negative impact on investment. So I think there is this positive interaction between the political process and the cycle, but there's also a race between the two, and of course, as the more we advance, the less time available to actually make genuine progress to recover a stabilization capacity that is today missing. That was the thrust of the message I wanted to give. I hope it was not overly confusing or negative. I'm not negative, actually. I'm quite optimistic, but I think it's really something that we need to keep in mind. We are not anywhere close to normal situation, and will not be probably for the remainder of the cycle.
So I'm the disruptor because I don't work for a central bank. I don't work for the government. I work for a small firm, and my job is to be a 50,000-foot economist viewing the entire global economy. And I'm pleased that I was for 3 years the chairman of the Global Interdependence Center, because I truly believe in a global economy. I don't believe there is a U.S. economy or European economy, and I believe that because the companies that I deal with are multinationals, and they're basically going around the world looking for the best rules, whether it be tax rules or labor laws or pollution laws or whatever, and where they pay their taxes and where they produce their goods and where they sell their goods are completely independent concepts to them. And in that global economy, what I've learned over the last really 10 years of traveling extensively is that I look at the world in 4 quadrants. I look at the United States as basically the suburbs, and I say the suburbs because unemployment's not the function in the United States. It's not a factory economy. In this last Great Recession, the unemployment rate soared to 9.7%. In the Great Depression, it was 35%. Functions of recessions in the United States are about the value of your stock portfolio and the value of your home. And then you have below that, you have the tier that I think of as the old industry, which today is Europe and Japan. It used to be the Rust Belt in the United States, but now it's Europe and Japan. And below that, the Sun Belt, which is basically China and the ASEAN, which are stealing technology and stealing jobs from the older sector. And then at the bottom quadrant of the pyramid is the commodities producers, who are punished by everybody else as supply and demand goes up and down. Well, in that world, you've had two interesting events in the last 6 months, and basically the last 6 months of Trump and the last 6 months of Xi in the Chinese economy. And I go back to Trump's election 18 months ago as the beginning of the cycle, and the reason is because it was unexpected, and at that time, the U.S. economy, in everybody's mind, was a world of twos. Growth was going to be 2% real, inflation was going to be 2% eventually, and interest rates were about 2%, and it could have stayed that way pretty much forever, because potential growth was like 175, and so 2% growth when you still had slack meant that you could go on and on and on in this environment. And we were going on and on and on, and that was my prediction and basically everybody's prediction for 18, 19, 20, 21. Then Trump got elected, unexpectedly, relatively unexpectedly, and we had a massive burst in confidence among businesses who felt that they were going to get deregulation, tax cuts, the end of Obamacare, and a perfect environment run by a businessman. What they got was deregulation, and the tax cuts had to wait for Obamacare, because the legislature, the Congress, went for Obamacare before they went for tax cuts. And it took them almost a year to decide that they weren't going to be able to kill Obamacare. And so it was a year before they moved to the real stimulus, which was tax cuts. And when we finally got the tax cuts in December of last year, there was again a burst of euphoria. But I never really bought into that, because the tax cuts, the fatal flaw in the tax cuts is it dropped tax rates from 33 to 21%. It gave American corporations a lot of cash flow, but it didn't tell them where they had to spend it. And the simple reality was, after the tax cuts, the marginal tax rate in the United States was 21%, but it was still 11 in Ireland, it was still 15 in Hong Kong, it was still 15 in China. It was still better to go someplace else. We had changed a 4% growth world, 2% real, 2% inflation, with a 33% tax rate, which means you get to keep 2 and 2/3, into a 5, maybe 6% nominal growth rate world, 3, 4% with 2% inflation, maybe 2.5 on a short-term overrun, with a 20% tax rate, which means you get to keep above 5%, but it's easy to make 5% nominal in a 10% tax world pretty much anywhere in Asia. And so that's where most people continued, the multinationals, continued to be focused. They brought some money home to distribute it through dividends or share buybacks, so that it could be redistributed, but mostly outside the United States. So the exciting thing was the spending increases, because when the spending increases came, the federal government announced that it was going to spend $200 billion more by the end of fiscal 2019, which at this point is only 15 months away, than it was spending at the time. And every single dollar was going to be spent in the United States, because it was either defense spending or infrastructure or medical care or some residential, something that was going to be very, very heavily dependent on U.S. consumption. And more importantly, they were going to spend the money, and they were going to spend it fast, because the government doesn't have a profit motive. It has a spending motive, because if it doesn't spend the money allocated to it this year, it doesn't get the money next year. So what we've got now is an economy in which growth, the Atlanta Fed in their infinite wisdom, David now says we're going to grow 4% in the second quarter after 2.3 in the first. I think a 3% growth rate over the course of the year, instead of the 2.2, maybe 2.5 after the tax cuts that people were talking about, is now realistic. And for me, the question is, how much pig piling on that strong growth do you get? I mean, if we start seeing numbers reported that are north of 3, does that stimulate even more activity from the individual sector, where they go out and buy houses, cars, because they feel their jobs are guaranteed? So how far and how fast can we go? I'm not talking about the ending. I don't know where the ending is. I'm just trying to figure out right now how fast the U.S. ramps up. And is that completely independent of the rest of the world? Well, the answer there is no, because Trump, immediately after giving this big spending stimulus that was going to generate this 3% plus growth, said, but you have to spend it in the United States. I'm going to have an America First policy, and I'm going to really start enforcing it, and that's when we got the tariffs, and that's when we got the rollback of Iran. You got a lot of different policies out there that basically indicate that you're going to have to spend your windfall from the tax cuts in the United States. Now, the problem for Trump on that is the midterm elections, because it's only 6 months away, and it's a 180-degree deviation in the United States as to where policy goes. If the Democrats take the House, then Trump will be impeached each and every day for spitting on the sidewalk, for insulting someone on TV. He'll never be indicted because they'll never get 2/3 of the votes in the Senate, but there will be a constant drumbeat against him from the legislature. And he'll be a lame duck, just as George W. Bush, just as Obama were, just as Clinton was for their second 6 years. If he wins, however, I'm not really sure what happens if he wins, because Trump's history is that if he accomplishes something which people tell him he can't do, he becomes almost unchained in the strategies that he'll undertake. And only when he's then bursts, goes bankrupt or whatever, does a strong disciplinarian be put in charge of him who controls him. I know this because I used to work for the Boston company, and we're the idiots who lent him $17 million to buy Adnan Khashoggi's boat, and then followed it up after he didn't pay us with another $15 million to buy Mar-a-Lago. He didn't pay us on either one. So this is where Trump's going, and this is what the multinationals are looking at in the United States. But there's a second player on the field, and that's Xi, who has consolidated his power in China, tremendously consolidated his power in China. Of the 300 people currently in the ruling party now in China, probably 250 of them are direct acolytes of Xi. Think of the United States Senate as having 5 Republicans to every Democrat. That's where you are in China right now. Everyone elected in the next generation of power in China will belong to Xi Jinping. So he doesn't need to be president for life. That was an advocacy to make sure that he wasn't a lame duck. He was already going to be chairman of the party for life, and there is no term limit on chairmanship. And whether he's chairman or president or head of the military commission doesn't matter, because like Zhang before him, he's going to be playing the marionette master in the background for a long, long time. China, since Xi was reelected in the first quarter of this year, China in dollars grew $2.2 trillion. That's Brazil. That's the 7th largest economy on the planet in one year, going to that point. $1.2 trillion in the first quarter alone. Half of that was because the Chinese currency has appreciated 10%, a snapback from its slowdown after the corruption campaign in 2015. And half of that's because the economy continues to grow 10% nominal. So what you have now is China still growing rapidly enough that it's dominating the commodity cycle. This is why oil prices are up, iron ore prices are up, copper prices are up, because their buying power in dollars is soaring. And they're using this buying power in dollars to go out and influence the world very rapidly. I mean, we're seeing this in Latin America, where they're in Brazil building, they're in Argentina, in Vaca da Muerta doing shale oil, they're in Eastern Europe, they're all over the place expanding their influence. And this is an interesting cycle, because the one country right now that is off cycle with the rest of the world is China. China is slowing itself down on purpose, because having just consolidated power, Xi is using 2018 to eradicate any remaining barriers to his long-term influence in China. He's reining in the shadow economy. He's reining in the anbangs and HNAs, those that were spending profligately outside of China. And he's really setting himself up to be able to stimulate the economy in 2019, because the one thing I can assure you of beyond all other things is that in 2020, the Chinese economy will be booming. And the reason it will be booming is because that's the centennial of the party. and there's going to be a big party for the party in 2020, and they're going to have to look good, so whether it is or not, it's going to be reported that way, and they'll believe it in China because the reporting's controlled, but they're giving up 18 to stimulate 19 to have a boom in 20. So you've got slowing China domestically, not internationally, because the U.S. stimulus is helping China internationally, as we've seen in the trade deficit. So the one thing you can be absolutely sure of for 2019 is that the trade deficit of the United States is going to get larger, and it's going to get particularly larger against China, because everyone in the United States got a tax cut, and they're going to spend roughly 25% money outside the United States, which mostly means on Chinese goods, and no one in China got that tax cut, and they're being constrained on credit growth inside the country, so they're slowing down. So their ability and demand for foreign goods of all kinds, including American, is slowing down. So you're going to get a widening of the Chinese-American trade deficit at a time when Trump is pushing this America First agenda. So these trade issues are going to come back again and again and again through the year. And you're going to see this ebb flow that you're seeing right now, where we punish CTE and then we say we're not punishing CTE, and then we'll go back and forth. To me, this increases volatility. But the big thing is that the United States is probably immune from a downturn for 12 to 18 months just because so much money has been fired into through fiscal stimulus. And China's probably immune, one, because they're slowing down, and two, because China lives in the perfect place in the world where, as the global economy slowed down, as it did in 2015, based on their corruption campaign, they stole technology from Japan and Korea and Europe above them, and they punished the commodities producers, Saudi Arabia, Argentina, Brazil below them, and they basically didn't have a recession in China domestically. And they'll probably be able to do that again. So you've got the top, the United States, which is the source of the stimulus, immune from a recession. You've got China, the new economy, immune from the recession. Who does that leave at risk? That leaves Europe and Japan, who think that they're trailing the American cycle by 2 years, and they'll discover abruptly somewhere in the next 18 months that they're ahead of that cycle, that they're the one that goes down first, not America. And most importantly, the EM, which started borrowing in dollars last year when the dollar was weakening, and it looked like a really good idea. And they borrowed a lot, and now they both have short rates going up and the dollar going up, and they're getting squeezed. Depends which commodity you produce, but in a world where energy's going up, interest rates are going up, labor prices are going up, all in dollars, and you're a commodities producer in the EM, that's not a good place to be. And so I think that's where we're going to see the problems first. That's my story, and I'm sticking to it. We'll bring Arnaud up, and we'll take questions. Questions from the audience? Or stunned silence? No.
Kathleen Stephens. So this is a question for Arnaud. Given your discussion on fiscal policy, do you find that there is a disconnect in the pricing of sovereign bonds in Europe?
I don't know. I'm the most qualified to have a view on pricing of bonds, but yeah, there's something that I find. The way I think about it is, if you hold a 15-year bond or even a 10-year bond in a world of low nominal yields, where effectively in a bullet bond all the cash flows are backloaded, most of what you have will be paid or not paid after the next recession. So therefore, you should worry an awful lot about what happens in the next recession. My sense is that recently, if you want, the growth was good. People have been sort of reassured about politics, and also nobody wants to miss a good performance. Over the near term, if spreads are compressing, you don't want to stay behind and lose a year's performance because maybe the problem is only 2 years down the road or 3 years down the road. But that I think should change over time, and almost mechanically, the probability of a recession every 1 year increases geometrically as time goes by. So therefore, that's at some point should be reflected in the pricing of bonds. But the market knows best.
Michael, when you think about growth in China, how do you separate actual expansion of commerce and finance from just the allocations made by the party? Is there any differentiation at all, or does it matter?
In some sense, there's no differentiation at all. Think of, I was just in Pittsburgh giving a speech, and I go there a lot. When Pittsburgh was a steel town, everyone worked for the steel industry. I mean, it didn't matter if you were a greengrocer on the corner. You worked for the steel industry because everybody you sold to worked for the steel industry. In that sense, everyone in China works for the party in one way or the other because the party controls well over half of the allocation in the economy. But I think the way to think about China is as a roller coaster, a 3-year, very rapid cycle where it goes from 3% growth to 9% growth and back. They bottomed in 2000 on the global recession, the U.S. downturn after Y2K. They bottomed in 03, they bottomed in 06, they bottomed in 09, they bottomed in 12 on the European, they bottomed in 15 on their own corruption campaign, and now it looks like they're bottoming in 18. And that's exactly the same cycle that the United States had from the 1880s to the 1920s. That's typical of a heavily oriented durables manufacturing economy. And so I think of them as the United States in maybe up till 1920.
So just to follow up, at some point, if yuan continues to appreciate against the dollar, does Xi have to open the window again and let Chinese start taking capital out of the country?
Well, he's trying to force it west in the country. He's trying to there's still 500 million people living in the countryside, so he wants more of an agriculture, more of it in the west of the country. They're trying to move all the pollution from the east to the west. So they basically have to rebuild the country. So he's got plenty of use for capital inside the country for quite some time. Think of it as the railroads being built in the United States in the 1860s. Yes, sir.
Yes, this question is for Arnaud. It seems when we listen to you that on a regular basis you show that ECB has some rationality towards what most governments should do. Having your experience to the ECB, do you consider that governance is really an issue which prevents ECB from being more proactive towards government efforts?
Sorry, do you mean that the ECB is subject to political pressure?
Yeah, sure. In a nutshell, you just explained to us that the government should make some efforts, so reforms in Europe, and that the timing is just perfect. That's the reason why ECB has maintained interest rates with such a low level, but nothing really happened. And nothing really happened because you are absolutely convinced, and most people like you are convinced of what should be done, but on the other way, it's not that easy for governments, and many of them are not really doing some efforts.
So I think you've got many questions underlying this. So first, something which I think is behind your question, but which is, should the central bank not do everything it can to reflect the economy? Because fundamentally, it knows that governments should reform. That would be the better route. And by not taking everything on its shoulders, it increases the pressure on the government to do the right thing. So this, I think, it doesn't really work because the central bank has a mandate to deliver price stability, whatever happens. And in fact, central banks, I think, are very weak. They're very weak in the sense that they've got to operate in whatever environment is thrown to them. So therefore, it's not possible for them to just trigger a crisis or let a crisis happen just to teach a good lesson to government. So again, for me, the concept of monetary dominance actually means that the central bank is, from that point of view, really dominated in terms of the environment it works on. Then after is something happening? No, I would argue that actually lots of reforms have been happening in Europe. There has been structural reforms over the past many years in many countries. I mean, they're happening now in France. You could argue a bit later than other countries, but I think reforms happening. I would also argue that the view that reforms only happen under stress is wrong, because we see now in France, as a good example, reform actually happening in a time of expansion. So not at all under stress. In fact, in a situation where the stress is most relieved. So I think that that happens. What bothers me more is the institutional. So I think reform within countries happening more or less fast. I mean, clearly, you could say more should happen in Italy, or Italy may undo reforms that were good ones. More has happened in other countries. What I think is sorely missing is this institutional reform in Europe. So the governance of Europe. There, I think, again, good things have happened. So I don't want to sound overly negative. There has been a lot of progress towards banking union. It's not finished. There is progress towards capital market union. I think we're very far away from the desired outcome. And almost nothing has happened on the fiscal side. Then after that, you have the question of, okay, if this doesn't happen, when you have a shock, can the ECB bail everybody out? And then I would think no. I think it would be extremely dangerous. And it would be extremely dangerous because there's two things in my view that can really undo Europe. One is the inability to stabilize the economy, that will essentially put countries in a situation where they have no choice but living. And the other one is if we create a sense of inequity, of unfairness between European countries, which is such that then political centrifugal forces develop and start to overwhelm centripetal forces, the forces that link Europe together. And I think that if the ECB were being asked in the future to act as a backstop for the Eurosystem as a whole, inevitably that would be seen as generating fiscal transfers between countries, an accusation which has been leveled against the ECB, and I think wrongly, but would be leveled against in the future. And I think that would essentially fuel an existing sense of inequity in Europe that would actually make the situation politically more fragile. Today in Europe, I think we've got a very fragile social cohesion, and it always comes back. That's why I'm so obsessed about fiscal issues. It always comes down to the fiscal issue. It is always a question of sharing fiscal money. And it is typically at the moment, when we think about inequality in a global sense, we tend to think about poor people left behind by the process of globalization and frustrated, and understandably so, with the fact that a small part of the population confiscate most of the wealth and income. But in Europe, between regions, it's a reverse sense of inequity. It is the regions of countries that did well, often did well from this process of integration because they implemented the right policy to increase productivity, competitiveness, and they are frustrated and reluctant at the idea that they have to share with countries that did not so well, even in the form of joint insurance. And it is everywhere. It is the lack of support in the north of Europe for the south of Europe. It is UK leaving the EU. It is the Flemish in Belgium not willing to share their pool of fiscal money with the Wallon. It is the Catalans in Spain not willing to share their pool of fiscal money with the rest of Spain. From my point of view, it's the only aspect that makes this Catalan story somewhat interesting, is that it is a symptom of a lack of social cohesion in Europe. And I think if we were to ask the ECB to step in and essentially intermediate with backstop governments without a proper governance framework, I think that it would fuel this sense of inequity, and it would fuel centrifugal forces, political forces, that have not been put to rest last year. I think they are still there. And so from that point of view, I think it's quite dangerous to ask the ECB to always be the backstop to everything and everybody. I don't know if I answered your question, but I try to answer as many aspects.
We have time for one more.
I sense quite a gap between Arnaud and Michael, and I'm wondering if in the privacy of your investment policy committees, you point to any specific layering or leveraging of risk which most of us are not aware of. I'm thinking specifically of the accumulation of mortgage-related debt and derivatives thereon, credit default swaps and so forth in 2006 and 7, which most of us did not identify. What do you really worry about at this point?
So two things I worry about most is, one, that everybody's worried about debt. I don't worry about debt at all. Debt is the transfer of control of ownership of assets from those that don't want to take risk to those that do want to take risk. And what wealth concentration means to me is that there are fewer and fewer risk takers in the world. And therefore, I'm not surprised that productivity is quite low and that monopolization and control of prices and those kinds of behaviors are dominant in the global economy today. The thing that I worry about the most is the speed at which China's influence is spreading through the world. And most people I talk to in the United States are worried about the demographics and whether they're going to collect Social Security in 10 years. And I'm worried about the fact that the President of the United States, elected in 2024, will be elected as the leader of the second largest country on the planet. That's going to happen in 5 years, maybe 7, maybe 10. The demographic issues aren't going to happen for 10 years. So I worry about the one that's going to happen. We break for lunch? Or can Kathleen sneak one in? Okay.
Thank you, Don. If your scenario, Mike, is coming to fruition...
And it is.
And it is. What then, Arnaud, would the ECB have to do in order to avoid, or what would be the scenario here in Europe in order to avoid the cliff that Mike is looking at for Europe and Japan?
The short answer is I don't know. I think I don't want to divert this question to Olivier. I think it'd be a better place to answer. But I think part of the answer would be to discuss about multi-fiscal coordination, and then I think we'll have to support domestic demand in a much more aggressive way. So yeah, I think it will be multi-fiscal coordination in some way. But that's the thing. I'd have to give a much longer answer, and that's probably not the time for this.
So we're going to break for lunch, and we'll be back at, where's Jill? I don't know the times. 1:45. I look forward to seeing you all this afternoon.